Do you want to know how you can time the Forex market makers for bigger risk to reward trades? Do you want to know how you can time the market accurately and consistently while increasing your reward but not increasing your risk? In today's video, you're going to learn how you can take advantage of some of the big institutions and Forex market makers in the Forex market and use their behaviors to make great trades for bigger profits. You're going to want to watch till the end, so stay tuned because there are lots of tips throughout the entire video. Go ahead and click that subscribe button and click the bell for notifications as well. You can do that while this intro rolls. Join our community where we're trying to turn everyday traders into pro retail traders. All right, time to get our minds in the trade.
Late afternoon trading is just it's getting to be a casino. So whoever buys the next buys or sells 100 million and just moves it one big figure, and it means nothing, you know. I mean, as far as the next 24 hours, just makes everybody run. They get in, they get out. Always at the bottom of the top, and
so I'm leaving.
okay, we'll leave it.
All right, pro retail traders and aspiring pro retail traders. All right, so what you just saw was another clip, this time from the speculators' point of view. By speculators, I'm just talking about the smaller, fun, but still a retail trader, nonetheless, just a bigger retail trader. Who we saw speaking the most was a guy named Brad Chesterfield. You can check it out in the documentary $1 Billion Day. He actually works with or for the guy who owns this fund, Ronnie Schlatford. He's the other gentleman who you see at the end, basically like, yeah, we're getting out of here. Yeah, you know, our day's over. And it says that at the beginning, sometime in the documentary, this guy, Ronnie, he's got 13 clients, and it's a $500,000 minimum just to get in with him, you know, and he made like 50% the prior year to this documentary being recorded for his clients. So, you know, they're loving Ronnie. And Brad basically goes on a little bit of a tirade, and he's upset. You can hear it in his voice, you can see it, and he's like, it's like, it means nothing, you know, they just spike the price and it moves one big figure and it means nothing, you know, in regards to the next day, the bigger picture or the intermediate picture. And he's right, but he's also wrong. And how can he be right and wrong? Well, it means nothing in the context of you thought it was going to do something based on what it just did. It fooled you. It sold you that it was going to pick a direction and really take off and continue in that. That's what they teach most retail trades. Like, this is momentum. The market's weak or the market's strong. You know, they're coming in, they're buying, they're selling, and it doesn't continue. It turns away and goes back up, or it turns gray and it goes down. So that is something that a lot of traders, retail traders, are getting caught up with. And that's what we're going to talk about here. If you noticed, Brad mentioned late afternoon. Timing is a lot in the Forex market. You got to keep that in mind as a retail trader becoming a pro, or if you're a pro, you know, that's something you'd already keep on your brain, is the timings of the market, because certain things happen at a particular point in time, and there's a lot of different factors of why that is. Liquidity is a factor. There's also a factor of when people come in to do business is a factor. There's also the psychological factor as far as how they are perceiving the market action so far. And I say that last one because that's true. A lot of the bigger players can look at the market and see how things are set up and understand the type of time, or mind frame rather, people are in based on the action of the time frame. You know, if you see a slow grinding trend and price hasn't been moving that much, but it's been leaning one way or the other, you know, in this case, we'll just say to the downside, most people think they'll see a breakout as soon as price explodes to the downside, and will take that trade more times than not, because psychologically, you're already prepped for that move. So right here, you'll see we have our days marked. We have Tuesday, Wednesday, Thursday, Friday, and it goes on and on throughout the chart. So timings, this is Tuesday. This is the start of a day, right? This candle, actually. So if this is the beginning of Tuesday, this is also the end of Monday, which is late afternoon trading for New York, almost going into evening, if you will. And if you look, this spike up right here gets a lot of traders going long, and it's in the context of strong market. We're going long. And let's just see how big this candle is here. I mean, this is a really big candle. This is 101 pips. This is a really big candle. And this is on a 30-minute time frame. So, in other words, this got a lot of traders excited to continue up, take trades, jump in the market, let it ride, whatever the case may be. And one thing's for certain, it didn't keep on going. So when we come down and we look at this spike, this is another spike, right? It didn't have a wick like this. It didn't reject the same way, but nonetheless, this is from up here to down here. It's a spike. Now, when did this spike take place? This spike took place late London afternoon. Now, this box right here, this bluish box, denotes the opening of the New York session. Yes, the New York session and the London session both overlap, but remember, if you started up here at this maroon box, which is the start of London, and you've gotten now to right here, you're in the afternoon. You're in London afternoon. And that to you is starting to get late in your session. There's only a few more hours left to the day for banking and trading in the London session closes. It's only a few hours left. So that's late afternoon. When that spike takes place, people are already positioned possibly short, and they're getting shorter because in the background, if you look here, we already have a trade that looks like it's going down, right? You got this spike, this confirmation that, oh, the market's weak, it's a blow off top, whatever the case may be, and then you get this. Now, once you get this, what happens? On a dime, it stops and goes back the other way. Wow. But let's keep going. Next day, Wednesday. Goes up, goes up, goes up. Late afternoon spike. Remember, first blue box, Asia. Next blue box, London. It's London, New York overlap. So when the blue box closes, mind you, that means the London market has closed. Okay? It means that's done. So now we're coming up, and what do we see? We have another spike, late afternoon. Boom. And there's a lot of end of day traders out there. Trust there are people who only trade the New York session and people who only trade end of day. So there's orders there. And then it comes down, not to be seen again. So we're going through it, and I'm looking for bigger moves, but I can slow it down and show you the same principle, no matter what. So for example, if you look here, end of London, right? At the Asian session here, New York, London overlap. End of London, we get a spike down. Boom, another spike. Comes back up, continues. What do we have here? We got a spike. Remember, first blue box, Asian session. Second blue box, New York, London. So right here, right before New York opens, this is late afternoon. This is getting late afternoon for London. We get a spike up. It moves down. So what are we seeing here? We got Asian session. We have London, New York session. London closed. Late afternoon. We get this spike up. Doesn't look like a spike in terms of a wick, but watch how price impulse moves out of there, and then it just turns around. Never to be seen again. Does not touch again. And it just continues to go down. Watch what we're doing. Watch what we're doing. Okay. This is Thursday. Asian session. London, New York overlap. London closes. But look at this. This is one big move. Boom. Late in the afternoon for New York. Middle of the afternoon, because this is 12 p.m. When it closes. So this is about 12:30. London's done. We get a spike to the downside. Comes up. Doesn't go back. And we can find that all throughout the charts. See if we find another one. No, well, this is actually current today. Did we actually get one? Nope. Pretty much nothing on those. And we can go through the charts. So with those examples that we just saw, we're looking at what is called shakeouts and upthrust. The person who termed them shakeouts and upthrust was none other than Richard DeMille Wyckoff. He was a guy who actually came up with those terms. Now what's happening is the smart money is basically saying, listen, we have people in the market position one way, or we have orders coming in, we can take advantage of them, and they're moving it. They're taking these times to move the market. For whatever reason they're doing it at those times, it's consistent, and that consistency is a pattern that you can build on. So for example, if we know to look out for spike ups in the late afternoon, like for example, we just scrolled back here, just scrolling, and I'm seeing this. So this right here, this is a Friday, this is Asia, this is New York London overlap, and we get this push up right here, and then it's taken away. This is late afternoon, London especially, and this is getting into the late afternoon for New York. When this box closes, it's 12 p.m. in New York. So it's not quite late, it's not quite afternoon yet for New York, but it is definitely late afternoon for London. And we'll be going over this in other examples as I show you trade setups and I explain things in detail. But right now, I want you to go through your charts and I want you to actually look for these things. This is a sessions indicator, iSessions indicator. You can actually get this for free on various places. I'll link to some and put it in the comments so you can click on it and find them. What you need to do is separate the markets by time of day, because particular actions happen almost on a daily basis at specific time of day. They vary by 15 to 45 minutes. So, you're not gonna have something happen every time at, 10:30 a.m., but it may happen at, 9:15 a.m. one day. It may happen at 11 o'clock a.m. Eastern Standard Time one day. But it'll always be around the times. And if you look at certain behaviors and you keep this in mind in terms of context, remember, context is king. You keep timing of day in your mind, you will be able to take advantage of the market. You know where you are. And that's in itself a trade setup. So this was just a short video to introduce a concept. And remember, it was shown also in the documentary that this happens since the 80s. This is a documentary came out in 86. They've been doing this. And why do they still do it? Because it works. If it ain't broke, don't fix it. So that's what we have. I want everyone to go through their charts, look for these things. Trust me, this is very powerful. We're going to be building on this as time comes. I'm going to show you exactly how you can use this. I'm not going to just lead you on. I just want to give you piece by piece by piece. We have a lot to go through. And, listen, the Forex market, literally other than the world bond market, is the biggest market in the world. It really is. And the bond market, it really is just a reflection of the Forex market, because all it does is tell you the price of money for any given industry. That's all it is. And at the end of the day, Forex market is the elephant. And what's the best way to eat an elephant? Piece by piece, baby. So that's how I'm going to give it to you. Piece by piece. And trust and believe, we're going to go into detail, in depth, more stuff that is usable, not just fluff, not just concepts, usable intel with proof. There you have it. Hit that subscribe button and bell for notifications. Also, leave a comment down below telling me what it is you want to see more of. Sharing this will actually help other traders. So until next time, remember, to trade like a pro, you have to train like a pro.